A stock market crash is not simply a bad day on Wall Street. It is a sudden, sharp, and often panic-driven collapse in the value of publicly traded equities across multiple sectors, typically triggered by a combination of economic imbalances, investor psychology, and systemic vulnerabilities. Unlike normal market corrections, which are healthy and expected within cyclical economies, crashes represent a breakdown in confidence that spreads faster than fundamentals can justify, leading to cascading sell-offs that erase trillions in paper wealth within days or even hours. The mechanics behind a crash are rarely about a single event. Instead, they emerge from layers of overvaluation, excessive leverage, speculative bubbles, and external shocks that converge to shatter market equilibrium. When investors begin to doubt the sustainability of asset prices, whether due to rising interest rates, geopolitical instability, corporate earnings deterioration, or liquidity crunches, the first wave of selling begins, and if that wave triggers algorithmic trading, margin calls, or institutional deleveraging, the decline accelerates beyond rational control. What makes crashes particularly dangerous is their feedback loop. Falling prices induce fear, fear induces more selling, and more selling pushes prices even lower, regardless of underlying company health or long-term prospects. This dynamic is amplified in modern markets by the speed of electronic trading, the interconnectedness of global financial systems, and the dominance of passive investment vehicles that must sell indiscriminately during downturns. Historically, crashes have exposed hidden fragilities in the financial architecture, from insufficient regulation to over-reliance on complex derivatives. And while each crash has unique triggers, the psychological and structural patterns remain disturbingly consistent. Investors often fail to recognize the warning signs because markets can remain irrational longer than logic suggests, and because human nature tends to extrapolate recent gains into indefinite futures, ignoring mounting risks until it is too late. Understanding a crash, therefore, requires not only economic literacy but also behavioral awareness, recognizing when euphoria has replaced analysis, when debt has outpaced growth, and when liquidity is an illusion rather than a guarantee. This lays the groundwork. A crash is not an anomaly. It is an inevitable consequence of unchecked speculation, structural imbalance, and collective psychological failure operating within a complex, high-speed financial system. The anatomy of a market crash can be broken down into identifiable phases, each marked by distinct behaviors, triggers, and consequences that unfold with predictable intensity once the initial threshold of panic is crossed. The first phase is typically the denial phase, where early warning signals, such as inverted yield curves, declining consumer confidence, or deteriorating corporate margins, are dismissed as temporary noise or isolated incidents, even as valuations reach unsustainable levels. During this period, retail participation often surges, driven by FOMO, fear of missing out, and media narratives celebrating new era economics, while institutional players quietly reduce exposure or hedge their positions without triggering alarm. The second phase, recognition, begins when a catalyst, perhaps a major bankruptcy, a central bank policy misstep, or a geopolitical rupture, forces the market to confront reality, causing initial sharp declines that test investor resolve. If the decline breaches key technical levels or psychological thresholds, such as round-number indices or 52-week lows, algorithmic sell programs activate, margin calls cascade through leveraged portfolios, and liquidity evaporates as buyers vanish and sellers multiply. The third phase, panic, is where rational decision-making collapses. Investors sell not based on fundamentals but on fear of further loss, triggering fire sales, forced liquidations, and contagion across asset classes as correlations converge toward one. In this phase, even high-quality assets get dragged down indiscriminately because the priority shifts from value preservation to capital preservation. Getting out becomes more important than getting out at a good price. The fourth phase, capitulation, occurs when selling pressure exhausts itself, either because most weak hands have exited, or because valuations reach levels so depressed that contrarian buyers re-enter, or because central banks and governments intervene with liquidity injections or policy support. The final phase, stabilization and reassessment, is where markets begin to digest the damage, rebuild confidence, and slowly price in a new reality, though recovery is rarely linear and often punctuated by false rallies and renewed volatility. Each of these phases operates under its own internal logic, but they are interconnected. Failure to recognize Phase 1 makes Phase 2 more violent, and delay in policy response during Phase 3 can extend the damage into years rather than months. Understanding this anatomy allows investors to position themselves not reactively, but proactively, adjusting risk exposure, diversifying assets, and preparing psychologically for the inevitable turbulence that accompanies financial cycles. Underlying every major market crash are structural vulnerabilities embedded within the financial system, weaknesses that may remain invisible during periods of growth, but become catastrophic under stress, turning isolated failures into systemic collapses. One of the most critical vulnerabilities is excessive leverage. When investors, corporations, or financial institutions borrow heavily to amplify returns, they also amplify risk, and when asset prices fall, the same leverage that boosted gains now accelerates losses, triggering margin calls, defaults, and fire sales. Another structural flaw is the proliferation of complex, opaque financial instruments, such as mortgage-backed securities, credit default swaps, or synthetic ETFs, that create hidden interconnections between institutions, making it impossible to assess true counterparty risk until the system begins to unravel. Liquidity illusion is another silent killer. During bull markets, assets appear easy to buy and sell, but when panic hits, bid-ask spreads widen, market makers withdraw, and even supposedly liquid instruments become impossible to offload without massive discounts. Additionally, the rise of passive investing, while beneficial for cost efficiency and broad market access, has introduced new fragilities. When trillions are indexed to benchmarks, selling becomes mechanical rather than discretionary, removing price discovery and accelerating downturns as algorithms dump shares regardless of individual company merit. Regulatory gaps also play a role. In many cases, oversight fails to keep pace with financial innovation, allowing shadow banking, unregulated derivatives, or offshore leverage to build up outside the purview of central authorities until it is too late to contain. Globalization adds another layer of complexity. A crisis originating in one region can transmit instantly through supply chains, currency markets, and cross-border investment flows, turning local problems into global contagions. Furthermore, the concentration of market power in a handful of megacap stocks or dominant asset managers creates fragility. When these too-big-to-fail entities stumble, the entire index drags down with them, and diversification becomes meaningless. Even monetary policy can become a structural vulnerability. Prolonged periods of ultra-low interest rates encourage risk-taking, inflate asset bubbles, and delay necessary economic adjustments, setting the stage for sharper corrections when policy inevitably normalizes. These vulnerabilities do not operate in isolation. They compound each other, creating a fragile ecosystem where a single spark can ignite a chain reaction. Recognizing these structural risks is not about predicting the exact timing of a crash, but about understanding where the system is weakest and adjusting portfolios, behaviors, and expectations accordingly. Market psychology is not a side effect of crashes, it is their primary engine. Human behavior, amplified by herd dynamics and cognitive biases, transforms rational markets into irrational stampedes, turning minor corrections into full-blown panics and delaying recoveries through persistent pessimism. The most powerful psychological force at play is loss aversion. Studies show investors feel the pain of a loss roughly twice as intensely as the pleasure of an equivalent gain, which leads to panicked selling at the worst possible moments, locking in losses rather than waiting for recovery. This is compounded by recency bias, where investors extrapolate recent trends indefinitely into the future, assuming bull markets will last forever during booms and bear markets will never end during crashes. Confirmation bias also plays a destructive role. During bubbles, investors seek information that validates rising prices while ignoring warning signs. During crashes, they fixate on negative news and dismiss any sign of stabilization as a dead cat bounce. Herd behavior magnifies these effects. No individual wants to be the first to sell, missing out on further gains, or the last to exit, suffering maximum loss. So everyone waits until panic breaks the dam and everyone rushes for the exit simultaneously. The availability heuristic skews perception too. If the last major crash was traumatic, like 2008 or 2020, investors overestimate the likelihood of another similar event, leading to premature de-risking or chronic underinvestment. Social media and 24/7 financial news exacerbate these biases by amplifying emotional narratives, turning isolated events into perceived systemic threats. and creating feedback loops where fear begets more fear. Even professional investors are not immune. Fund managers facing redemption pressures or quarterly performance benchmarks often act against long-term logic, selling into weakness to preserve short-term metrics. The most dangerous psychological trap is the illusion of control. Investors believe they can time the market, pick bottoms, or hedge perfectly, when in reality, crashes move too fast, correlations break down, and liquidity vanishes precisely when it is needed most. Understanding these psychological patterns does not make you immune to emotion, but it does allow you to design systems, rules, and safeguards that override instinct when instinct becomes your worst enemy. Automating investments, setting predefined exit points, avoiding constant portfolio monitoring, and focusing on long-term fundamentals rather than daily noise are not just strategies. They are psychological defenses against the self-sabotage that crashes exploit. When a crash unfolds, the immediate consequences extend far beyond portfolio losses. They ripple through the real economy, altering employment, consumption, credit availability, and even social stability in ways that can take years to reverse. The first and most direct impact is the wealth effect. As stock prices collapse, household net worth plummets, particularly for those nearing retirement or heavily invested in equities, leading to sharp reductions in consumer spending, the primary engine of most developed economies. Businesses respond by freezing hiring, canceling expansions, and cutting costs, including layoffs, which further reduces consumer income and spending, creating a negative feedback loop that can tip a recession into a depression if left unchecked. Credit markets seize up simultaneously. Banks, facing losses on their own portfolios and increased loan defaults, tighten lending standards, making it harder for businesses to finance operations and for consumers to access mortgages, auto loans, or credit cards, further depressing economic activity. Corporate earnings deteriorate not just from reduced sales, but from forced deleveraging, asset write-downs, and the cost of emergency financing at punitive rates, which in turn justifies further stock price declines and perpetuates the cycle. Pension funds and insurance companies, critical institutional investors, face solvency pressures as their asset bases shrink while liabilities remain fixed, forcing them to sell more assets or demand higher contributions, straining public and private budgets alike. Currency markets often react violently too. If the crash is perceived as a sign of domestic economic weakness, the national currency may depreciate, increasing import costs and inflation, or appreciate if seen as a global flight to safety, hurting exporters and widening trade deficits. Government balance sheets come under pressure as tax revenues collapse while demands for unemployment benefits, stimulus, and bailout surge, forcing difficult choices between austerity, debt accumulation, or inflationary monetary expansion. Social consequences follow: rising unemployment, declining home values, and evaporating retirement savings fuel political instability, erode trust in institutions, and increase mental health crises, effects that linger long after markets technically recover. Perhaps most insidiously, crashes reshape risk appetite for a generation. Investors who lived through major crashes often remain underinvested for decades, missing out on long-term compounding, while businesses become chronically risk-averse, stifling innovation and growth. The economic damage of a crash is never confined to Wall Street. It radiates outward, touching every household, every Main Street business, and every public service, proving that financial markets are not abstract games but the central nervous system of the modern economy. Protecting yourself during a market crash is not about predicting the unpredictable. It is about building resilience into your financial structure so that when the storm hits, you are not swept away by the tide. The foundation of crash protection is diversification, not just across asset classes, stocks, bonds, real estate, commodities, but across geographies, sectors, currencies, and risk profiles, ensuring that no single event can wipe out your entire portfolio. Equally critical is maintaining an appropriate asset allocation based on your time horizon, risk tolerance, and financial goals. Younger investors can afford more equity exposure because they have decades to recover, while those nearing retirement need stability and income preservation, even if it means sacrificing some upside. Liquidity management is another pillar. Keeping 6 to 12 months of living expenses in cash or cash equivalents ensures you will not be forced to sell depreciated assets to cover emergencies. breaking the cycle of panic-driven liquidation at the worst possible time. Hedging strategies, though often misunderstood, can play a valuable role. Simple tools like put options, inverse ETFs, or volatility-linked instruments can provide portfolio insurance, but they must be used sparingly, with clear objectives, and without the illusion of perfect protection. Behavioral discipline is perhaps the most underrated defense. Creating a written investment policy statement that outlines your strategy, rebalancing rules, and crisis protocols removes emotion from decision-making and prevents reactive mistakes during volatility. Avoiding leverage, whether through margin accounts, leveraged ETFs, or excessive debt, is non-negotiable. Leverage magnifies gains in good times but guarantees catastrophic losses in downturns, often forcing liquidation before recovery can occur. Regular portfolio stress testing, simulating how your holdings would perform under 2008-style or 2020-style crashes, helps identify hidden concentrations or vulnerabilities before they become fatal. Maintaining a long-term perspective is essential. History shows that every major crash has eventually been followed by recovery and new highs, but only for those who stayed invested and avoided locking in permanent losses by selling at the bottom. Finally, professional guidance, whether through a fiduciary advisor, a robo-platform with behavioral guardrails, or disciplined self-education, can provide the objectivity and structure needed to navigate emotional turmoil. Crash protection is not about avoiding loss. It is about ensuring that loss does not derail your life, your goals, or your future. Government and central bank responses to market crashes are not optional. They are inevitable, and their speed, scale, and credibility often determine whether a crash becomes a crisis or merely a painful correction. The first line of defense is monetary policy. Central banks typically slash interest rates to near zero or below, in some cases, to reduce borrowing costs, stimulate spending, and restore confidence, though this tool loses effectiveness when rates are already low before the crash begins. More powerful in modern crashes is liquidity provision. Central banks act as lenders of last resort, flooding the system with cash through repo operations, quantitative easing, or direct asset purchases to prevent financial institutions from collapsing due to short-term funding shortages. Fiscal policy follows closely. Governments deploy stimulus packages, tax cuts, direct payments, unemployment extensions, infrastructure spending, to replace lost private demand and cushion the blow to households and businesses, though political gridlock or debt concerns can delay or dilute these efforts. Regulatory interventions also play a role. Temporary bans on short selling, trading halts, or capital controls may be imposed to slow panic and restore order, though these often have mixed results and can undermine market efficiency if overused. Perhaps the most critical response is communication. Central bankers and finance ministers must project calm, clarity, and resolve, signaling that they understand the threat, have tools ready, and will act decisively, because in a crisis, confidence is as important as capital. Bailouts and guarantees, while politically unpopular, are often necessary to prevent systemic collapse. Rescuing key institutions, backstopping money market funds, or guaranteeing deposits can halt contagion and restore trust, even if it creates moral hazard for future behavior. International coordination is increasingly vital. In a globalized economy, unilateral action is insufficient. Synchronized rate cuts, currency swap lines, and joint stimulus efforts are often required to prevent spillovers and competitive devaluations. However, these interventions come with long-term costs. Excessive monetary easing can fuel future bubbles, fiscal stimulus can balloon public debt, and bailouts can distort market discipline, meaning every rescue plants the seeds of the next crisis if structural reforms do not follow. The effectiveness of policy responses also depends on timing. Acting too late allows panic to entrench. Acting too aggressively can create dependency or inflation. Ultimately, while governments and central banks cannot prevent crashes, they can and must prevent collapses, acting as the circuit breakers that keep the system from self-destructing. Looking ahead, the question is not if another market crash will occur. It is when, how severe it will be, and whether individuals, institutions, and policymakers are prepared to navigate it without repeating past mistakes. Crashes are not aberrations, they are inherent to market systems driven by human behavior, leverage, and innovation, and attempting to eliminate them entirely would require eliminating risk, growth, and freedom, which is neither possible nor desirable. What can be improved is resilience. building portfolios with structural buffers, designing financial systems with stronger safeguards, and cultivating investor mindsets grounded in realism rather than euphoria. Technological advancements, from AI-driven risk modeling to blockchain-based settlement systems, offer tools to detect vulnerabilities earlier and respond faster, but they also introduce new risks through complexity, cyber threats, and algorithmic herding. Demographic shifts, aging populations in developed economies, rising inequality, and slowing productivity growth create structural headwinds that make recoveries slower and more fragile, increasing the social cost of each crash. Climate risk, geopolitical fragmentation, and supply chain reconfiguration are emerging systemic threats that markets have yet to fully price in, meaning the next crash may originate not from financial excess but from physical or political disruption. For individual investors, the path forward is clear. Focus on what you can control: diversification, cost management, behavioral discipline, and long-term planning, and accept that volatility is the price of participation in wealth creation. For policymakers, the imperative is to strengthen regulation without stifling innovation, to build automatic stabilizers that activate without political delay, and to communicate with transparency and consistency to anchor expectations. For society at large, the lesson is that financial literacy is not optional. Understanding basic market mechanics, risk principles, and economic interdependencies empowers citizens to make better decisions and demand better governance. The next crash will come, perhaps triggered by debt defaults, AI disruption, climate shocks, or simply the exhaustion of a long bull market, but its impact does not have to be catastrophic. Preparation turns panic into strategy, fear into discipline, and loss into lesson. If you have learned anything from this breakdown, let it be this: crashes are inevitable, but ruin is optional. Like this video if it helped you see the market with clearer eyes. Subscribe for more deep, no-fluff breakdowns of finance, economics, and investing, because understanding the system is the first step to thriving within it, no matter what it throws at you. Drop a comment below. What is your #1 strategy for crash-proofing your portfolio? Let us learn from each other.